Hey everyone, it's Daniel here from etfs. Hope you're all doing well. So let's talk about jobs, right? So we got some jobs number on Thursday. These are more of the smaller numbers and kind of medium tier. Some were also very important, top tier as well. That I'll go through that maybe not many people focus on. But let's talk about first here the challenger job cuts. Basically, it's a data point that looks at the number of job cuts. And for the month of May, you could see that the number is 80,000 versus the 66,000 in the prior months. And when you look at this data point here, it's very interesting. You know, if you ever get a chance to search this data, it's very interesting to see that how there's been a spike since the end of last year, right? Where the last year's number in December, the number was sitting around 76,000. Now there was a dip to 43,000, and then we had a really high number in February of this year, around 102,000, and then a couple of fluctuations. But what's very important and key here is that these numbers are starting to pick up. You're starting to see the effects of the higher rates, of the inflation, of the companies being affected by all of this downturn in the economy, right? When you look at these numbers basically go all the way back, approaching to not 2020's peak levels, but back to end of 2020 levels, where the crash in the markets kind of bottomed out, and the markets were basically rallying, right? But the jobs number, the job cuts were still relatively high, although it was coming off from its peak. Now these numbers here right now have started to pick up, especially after looking at the lowest numbers in end of 2021 and start of 2022, when the numbers were around 19-20,000. That number is now all gone, and we're now sitting around the average of 70-80K. And this is going to be very interesting to continue to monitor. It's not a number that everyone focuses on, but very interesting, very important to watch out, because every time we see something is happening in the economy, aka recession, right? We see these numbers start to pick up quite drastically, right? And we're already seeing it right now. Now, it hasn't even hit the high levels or reached to, COVID's peak. We don't know if it will get there or not, right? But definitely it is a warning sign that, hey, you are getting the job cuts. You are seeing, as you've heard, and even on this channel, many of the tech firms laying off workers. But it's not only tech now, right? You're seeing it in other industries like finance, investment, banking, right? The investment banking. What did the investment banking industry and even consulting industry say? That, hey, we gotta slow down because mergers and acquisition is not doing as well as we thought. So hey, we gotta cut some workers out and save on our cost, right? So this is just the start. You're just seeing the start of all of this start to creep in. You're seeing the effects. There's a lag effect to rates on how it affects the economy. And remember, what they're trying to do, the Fed, the central bankers out there, they're trying to create the slack, the unemployment rate, the job losses to basically increase, so that this inflation can be tamed. This is how you can do so. Now, the other data points that came out on Thursday was also ADP. Now, this number is a little bit conflicting, but the number comes in basically at 278,000, basically saying that, hey, there's more jobs, right? Look at continuing jobless claims, same thing, much more better number. The people who are filing for unemployment claims are lower than the consensus, so that's a good sign. Initial jobless claims showed that as well. When you look at let's take a look at also the manufacturing numbers. ISM that came out at 10 a.m. on Thursday. The employment component came in at higher than expected at 51.4. So this ISM number is a little bit more important than the job cuts number that I started with, the Challenger job cuts number. But this ISM number is basically telling you in the manufacturing industry, right, employment started to pick up, right? If you try to maybe call certain people to get certain things done in the manufacturing industry, you're seeing some little bit of a pickup in demand, especially being the summer months, right? And according to this number here, there's a slight pickup. However, when you look at the new orders, when you look at the headline number, which measures basically how that industry is doing, it is lower than expected, and it is in contractionary levels. So basically saying that, hey, growth is coming down in the manufacturing industry. We see growth coming down, but the employment is still robust. We still need people. We're still looking to hire people. We're still looking to have people employed. So that's still doing well. But yes, the growth, the sales and whatnot is contracting, and the number sits in kind of in a contractionary zone, which basically hints, when you look at ISM, it hints towards also, again, recession. Whenever this number is below 50, you get that recession vibes and that recession indicator, especially if the number is way below 50, in which the headline is. It's sitting around 46.9. Slightly below the consensus of 47. So the ISM number basically coming in weak. The prices component of ISM also lower, basically telling you that, hey, prices are coming down. Yeah, because the growth component is being affected, so they're trying to maybe sell certain of these inventories, get it off their shelves. So what are they going to do? Try to lower the price to incentivize people to buy it, so they can get it out of their shelves and don't have to pay for any cost of storages and so on, right? So very interesting number here. And then on Thursday, because of this weak number and strong employment, you could argue that the June rate hike is less priced in than it was before. So the expectation of a rate hike is a little bit less expected because, hey, look, the growth numbers are weak. However, you could argue that, hey, the employment's still strong, especially on the ISM. So, I still think that maybe we're going to get a rate hike in June, right? But we'll see, right? We still got more data points to look at, especially when it comes to the inflation report, and we'll hear what the Fed has to say. Even if they do a pause, it doesn't mean it's a one and done. They can do a pause and definitely restart rate hikes again in the next meeting and onwards. So let me know what you guys think about this data and all these data points that are coming out. Hawkish, dovish? Is it signaling something? Do you see disinflationary signs here? Do you see recession signs here? We're seeing the prices component come down lower, but is this really good for inflation? And does that mean that, hey, we're finally going to see the Fed slow down on its rate hikes? Or that's not the case, and when you look at other components of inflation, especially like shelter, it's still high up there and something needs to be done. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.